Trump just won the election and Realty Income immediately dropped by 4% as a result of it. Moreover, it had already dropped by about 8% leading up to the election as the market became increasingly confident in the victory of Donald Trump, and as a result it has now dropped by about 12% in total. The market clearly thinks that Trump's victory is bad news for Realty Income, and in today's video I'm going to explain to you why. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing, and before I go into today's update, I want to make it clear that I'm not trying to be political here. I'm not even a US citizen, I'm not participating in your elections. I recognize that there are pros and cons in both parties and their proposed policies. I'm simply here trying to assess how different policies will impact various REITs like Realty Income. I'm just a REIT analyst, so please don't bash me in the comments just because I'm expressing some concerns on how tariffs could impact Realty Income and some of its tenants. Also, make sure to stick till the end of this video because I will discuss what I view as a better alternative to Realty Income for today's rapidly evolving environment. So what is Trump proposing and why is it bad news for Realty Income? The main thing that's concerning the market is Trump's proposal to put a 10 to 20% tariff on all imports regardless of the country, as well as a 60% import on everything coming from China. We think that such tariffs, if implemented, would have a very significant negative impact on certain good importing retailers, and to be more specific, we think that dollar stores and pharmacies would suffer a particularly large impact. And unfortunately for Realty Income, its three biggest tenants, representing 10% of its rental income, are Dollar General, Dollar Tree and Walgreens. The market knows that tariffs spell trouble for these top tenants of Realty Income, and this likely explains why Realty Income has sold off far more than most other REITs. But why would tariffs have such a big impact on dollar stores and pharmacies? There are 5 key reasons. Firstly, they serve a lot of low-income consumers. Secondly, they import a lot of goods, especially from China. Thirdly, they will have a hard time reconfiguring their supply chains on time to avoid an impact. Fourth, they are facing growing competition from larger peers like Walmart and Amazon. And then fifth, these companies have been already struggling in the years prior to the election, and we think that the tariffs will only make things worse. Note that we just posted a detailed report that's over 4,000 words long at High Yield Landlord, and you can read it completely for free. It's the first link in the description of this video. Make sure to also sign up. It's the free tier of our REIT newsletter to not miss similar future analysis. Realty Income holds a lot of exposure to these pharmacies and dollar stores which have been struggling for years, and we fear that things will only get worse under President Trump's new administration as these tariffs are implemented. Walgreens recently announced that it was shutting down up to 25% of its stores, causing its share price to crash to a multi-year low. Some investors now fear that it could suffer the same fate as its close peer Rite Aid, which is currently in bankruptcy. Similarly, Dollar Tree is struggling today and it's planning to close up to 1,000 stores, and just a day before the election its CEO decided to step down due to health reasons. Here also, a close peer of the company called 99 Cents is currently in bankruptcy, and while we think that Dollar Tree is going to avoid bankruptcy, it clearly shows you that this space is struggling. So far, Dollar General has performed better than its close peers like Dollar Tree, but these are the properties that I'm actually the most worried about. That's because real estate is all about location, 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 and Dollar General focuses on rural markets that have less competition. Those have been more resilient so far, but if tariffs now have a significant negative impact on Dollar General and they decide to close some stores, it will be very hard to release them, likely causing them to lose significant value. In the most recent conference call of Dollar General, their CEO said in their opening remarks that the consumer was today struggling already prior to these tariffs being implemented, and to quote him, he also added that we are not satisfied with our overall financial results. Their stock dropped to a 7-year low, and again, that's before tariffs are implemented. Therefore, I fear that Realty Income could face growing vacancies in the coming years because it's heavily exposed to some of the most tariff-sensitive segments of the retail market. And if I'm correct on this, then Realty Income could face further underperformance going forward because the REIT market hates such tenant difficulties. Just to give you an example, NAREIT, which is a close peer of Realty Income, just recently announced that they were facing a few tenant issues representing about 2% of their rental income, and this caused its share price to rapidly crash by about 10%. Realty Income today actually already has one of the highest vacancy rates in the net lease sector, and if it rises further, we expect it to very significantly hurt its market sentiment. But unfortunately, the bad news does not end here. The tariffs could also lead to rising inflation, which would then reduce future rate cuts and lead to higher long-term interest rates. We are now already seeing this happen with long-term interest rates surging following Trump's victory. This is very bad news for Realty Income because it's one of the most interest rate sensitive REITs of the entire market. It's focusing on net lease properties, which are the closest things to bonds in the equity market. I'll put a chart on the screen where you'll see the incredible correlation between Realty Income and long-term interest rates in recent years. You'll see there that when interest rates rise, Realty Income drops, and then when interest rates drop, Realty Income recovers. If the tariffs now lead to higher inflation, it will likely also lead to higher interest rates, hurting Realty Income's market sentiment. Does this mean that you should sell Realty Income? And it really depends on who you ask here, because not necessarily, if I think that this is bad news because it lowers our fair value estimate of the company. And so if you were in it for the upside, there's not as much of it left. And I would probably argue that there are some better opportunities out there. One of them would be WP Carey, ticker symbol WPC. This is another net lease REIT, but instead of focusing on retail properties that could suffer in the coming years, it's focusing on industrial properties that could actually benefit as the tariffs are implemented, because it will accelerate the trend of onshoring. Moreover, WP Carey also has CPI-based rent escalations in its leases, which should lead to faster rent growth if inflation accelerates, whereas Realty Income only has fixed escalations of about 1%, leaving it more exposed to the risk of inflation. However, if you're in it for the income, then I think that Realty Income remains a relatively attractive investment. It's today priced at a very reasonable valuation of about 13 times FFO. That's not particularly expensive. It's offering a high dividend yield of about 5.5%, which I believe is sustainable and will likely keep on growing by about 2 to 4% per year, even despite facing some occasional tenant difficulties. And therefore, if you're a conservative, income-oriented investor, I think that Realty Income remains relatively attractive. The bad news here is that Trump's victory will likely slow down Realty Income's growth rate going forward from 4 to 5% closer to 2 to 4%. This also lowers its fair value estimate and future upside potential. That does not mean that the company will die or crash down anytime soon. Its dividend is perfectly safe in my opinion. My point here is that you can likely do better if you're more selective and invest in some of the smaller and lesser known peers of Realty Income. Personally, I think that WP Carey offers better risk to reward in today's changing environment, and therefore I've been investing my money in this specific REIT in the net lease sector. And if you want to access my full portfolio, you can do so by joining High Yield Landlord, which is my REIT newsletter for a 2-week free trial. It will be the second link in the description of this video. We're also offering a limited time Black Friday sale there. You'll see it when you click on the second link in the description of this video. Otherwise, thank you very much for your interest. If you could please click the like button, that will help me a lot to keep on growing. Let me know what you think in the comment section below. Thanks so much. See you at my next one. Bye bye.